Good afternoon, Alex Cole, on this fine September 22nd. How are you today, my friend?
I'm well. We've had some weather here. We had some thunder in the morning when I woke up and a lot of rain, and dogs haven't had their long walk today.
You know, stormy weather seems to be showing up in the stock market as well. For everybody who's been paying attention, Fed announcement yesterday, another 75 basis point rate hike. We're not in the business of dissecting the commentary of Jerome Powell or any other Fed governors, but we certainly were a little surprised by how that took the market off its footing. It seemed to be priced in. Seemed that that was sort of the general awareness, and yet the market really plummeted. So, Alex, let's turn over to the GoNoGo charts, starting from our top level cross asset heat map. What are we seeing in the trend perspective?
Yeah, well, it was interesting that the equity markets painted a couple of amber bars on that strong rally just about 10 days ago, and then gapped lower and didn't get into go territory and stayed no go, and now we're making lower lows after a lower high. So the no-go now on the daily seems to be in place and sort of setting up to be a more persistent trend than perhaps people thought when we saw that rally. We look at the Treasury bond prices still in a no-go, weakened a little bit the last couple of bars. Commodities, they tried to get out of the no-go back into go, but have fallen away again. And I mean, I don't know how many times we can say this, Tyler, but I don't think I even need to say what's happening in the bottom panel.
Strength in the U.S. dollar. Investors holding cash. Seasonally, not what we typically see going into the final quarter of the year, but certainly markets dictate some different positioning, different allocation. So, Alex, let's go to the chart of the S&P 500. Let's take a look at that price action as we have returned to the no-go trend. Very heavy day yesterday. Certainly a lot of reaction to an additional rate hike by the Fed governor. But let's talk a little bit about this overall philosophy around trend following investing. And we've talked a lot about relief rallies on this show, and we've certainly talked to many portfolio managers and analysts amongst our clients who were really hoping for, right? But hope is not a strategy. Hoping for recovery, hoping for to reclaim those new highs. And what we've seen in these relief rallies is something very short-lived, something very volatile, at least on these daily charts. As you enter a go trend, it certainly has not been persistent. So as you're reading this chart, what draws your eye out?
Well, I think just what you said there is that I've heard lots of people say, once we get going, we're going to take off, right? We're off to the races. Yeah. After we do catch a new trend in the upward direction. But until that happens, you've really got to be disciplined in following your rules and your process. And if you look at a chart like this, we went into the no-go. We might have got excited here at the go, and we might have taken positions, but the trend changed back to a no-go and told us to get out of our long positions. And this go hadn't, like you said, it didn't persist for very long, even though it was much more significant than the relief rally we saw over here, which never got out of no-go. But you've got to be disciplined and you've got to be following your process. And if you can accept that you were wrong and you were hoping, like you said, for this go to take off, well, it didn't. And you were told then that the weight of the evidence and the trend conditions have changed again to a no-go. And you'd have been okay because even if you'd have taken some positions, you'd have then got out at, small win, and then you'd have been safe from this downside exposure, which is really what you need to be avoiding, is that drawdown. And so very interesting that, yes, we did get enough to paint this go trend, but it didn't last very long. And then when we went into amber bars here, we rolled back over into no-go. And like you said, then the news yesterday and the reaction to it really pushing us now to new lower lows on the daily chart of the S&P.
Absolutely.
And on heavy volume, don't forget that.
Yeah, exactly. Alex, talk to us a little bit about what's in that bottom panel on the GoNoGo oscillator. A lot of information compiled into one companion indicator.
Yeah. So when a trend takes shape, you want to see momentum in the direction of the trend. And that's what we've tried to do with the GoNoGo oscillator down here. We know that when the oscillator is in positive territory, then momentum is on the side of this go trend. But we also know that the way it's calculated means that when momentum falls away and when momentum becomes neutral, our oscillator will return to test the zero line. So when things are looking good, we expect the oscillator to stay above or at zero. So even here, if you were hoping for this trend to persist, you got a little bit of an advance warning when it wasn't able to find support at the zero line, right in here, that there was a threat to the go trend. And then the oscillator did indeed break below zero, fell into negative territory, and then the no-go took shape. And then this was a very important moment just a couple of weeks ago when we were testing the zero line, this time from below, to see if this no-go trend would persist. And we saw that it rolled away from the zero line, found rejection here, and that told us that trend continuation was likely in the direction of the no-go, and of course on heavy volume with the oscillator turning to the darker blue color.
Absolutely. And if technical analysis is a tool to help visualize what we are seeing in investor behavior, then certainly you've added a lot more information to this oscillator panel that helps confirm what we're seeing from that trend perspective. So when the line moves from the aqua green to a dark blue, we're seeing high relative volume. So on those sharp down moves, we're seeing heavy volume in SPY trading. Obviously, from a data visualization perspective, we also want to make sure that we're capturing that interplay between the oscillator and the price panel. So those red circles above price at the new no-go trend, we're seeing that as a continuation of the trend with the correlation of strong momentum to the downside. So for trend following investors, we want to see a market that's in trend, and we want to see volume and momentum come in to confirm that direction and veracity of the trend. So a lot of great visual tools built into the chart to really call out those opportunities. And for those who play to the short side, this is a chance to really lean into those positions. Alex, let's take the SPY chart out to a weekly basis. Obviously, the way we learned it, Charles Dow, and going back to the multiple time frame perspective can certainly help understand the nature of this environment. And for me, this weekly chart looks like a series of lower highs and lower lows. Talk to us about what the primary trend is telling us, Alex.
Yeah, we've been looking at this chart for several weeks now. And as you said, lower highs and lower lows is a downtrend. If you're just going to eyeball it, we saw some struggles with the trend indicator to maintain a color. But then once it took hold, this no-go trend now seems to be in place. We saw a rally over several weeks, causing the indicator to paint weaker pink no-go bars, but then it fell back into the strong purple no-go bars. And then what we've highlighted for the last couple of weeks in our research is whether or not the oscillator, having dipped into positive territory, would now find support at zero, which would mean that perhaps the no-go was in trouble. But in fact, this week we see the oscillator breaking back below zero, telling us that momentum is in the direction again of this no-go trend. And that's what's giving us this fresh red circle, which again is a trend continuation icon, meaning that in this case, we're seeing the trend in place and confirmation from momentum being on the side of the trend. So we're seeing a no-go trend continuation on the weekly chart, which suggests to me the price will make an attempt to take out these prior lows from June.
Absolutely. So that's our look at the U.S. equity broad index. Let's take a look at some of the macro drivers for this environment. Obviously, all eyes on the Fed yesterday, and that long-term trend of the TNX that we've been talking about on this show week after week. The rising rate environment in the United States and that need for the Fed to combat inflation before it becomes runaway is really important. I did a spot for Money.net Live just earlier this morning, and the host was talking a lot about fiat currencies and maybe changing the denominator in a lot of different assets because of the inflationary regime that we are in. And so when we look at the trend on 10-year interest rates, going back to our birth 40 years ago. It's been a real bull market for bonds. Remember, rates are moving inversely to bond prices. So this 40-year bull market for bonds is frankly over. We're above that long-term downward sloping trend line on a quarterly basis. This is very long-term data, but we've certainly seen it accelerate to the upside. And if we move into just a daily chart of the TNX, and we can see sort of the moves yesterday in anticipation of the Fed announcement, but certainly we're above prior highs. Strong blue go trend. Oscillator is in positive territory, certainly showing no signs of weakening.
No, we had this correction over the summer as equities tried to rally, but like you said, new highs, strong, uninterrupted blue go bars, momentum in positive territory now for a couple of months. And, like you said, we don't really see an end to this rising rate environment. And just to clarify, not to clarify, you said it so well, but to point out or to remind people what you just said about that long-term trend, it really does look like we've clearly broken above that line. And we've been showing that chart for 6 months, and now we aren't saying, well, if the quarter ends, where we are now above that line, 2 bars into a go trend on a quarterly chart. So the long-term trend indeed in place, and you can see that on the daily as well.
I want to mention maybe the greatest lesson I ever learned in technical analysis from the great Ralph Akampora, CMT charter holder and one of the founders of the organization. Early on, over a decade ago, I was in the office and just starting to understand some of these tools. Wanted to show him that I had learned a few things, and I said, "Oh, look there! It's overbought. It's a sell signal." And this was in 2011, I believe. And Ralph pulled me aside and he told me a story about Ralph Rotnam, the old timer who had traded through the 1920s and 30s and was the then director of research. And he said, "Ralph, when I see all of these overbought indicators on our charts, it tells me that the market is persistently enthusiastic."
Yep.
So, Alex, why don't you take a minute and just talk about those red triangles that we're seeing above price in terms of a counter trend signal in the interplay between momentum and the trend, but how we might interpret that in this very strong, persistent trending environment.
Absolutely, and it's a great point you mentioned, and I look back to the chart over here for maybe perhaps a more typical reading of that kind of environment. What we're highlighting on the chart with these counter trend correction arrows, these red triangles, are situations where price has moved very quickly in one direction and then has come off a little bit, causing our oscillator to come out of overbought and back below, in our case, a level 5. Now, typically we can say that might mean that price will struggle in the short term, as it did here, as it did here, as it did here, to go higher. But to your point, I've known a lot of people over my time and clients when I was working, in the city years ago, who would be buying overbought signals. Remember, overbought means, like you said, enthusiasm, or we say excessive buying, right? Heavy buying. And that will happen in a very strong trend, as it did here several times before that leads to a mean reversion type of situation. So there's definitely those two ways to look at it. When the markets are moving sideways and they're range bound, then that's what you're looking for. You're looking for a mean reversion idea when the oscillator comes out of an overbought situation. But when the trend is very strong, you often see these enthusiasm, this excessive buying happening all the way up an uptrend. So you definitely want to set tight stops if you're using these kinds of momentum ideas, and that's what we're seeing here at the moment.
Absolutely. All right, so let's turn our eye away from the TNX, but to another strong, persistent go trend. Let's pull up a chart of the US dollar, and just it really baffles the mind that we're continuing to see such strength. But obviously, you don't fight the tape, as Marty Zawag said. Alex, what are you seeing from a shorter term daily trend perspective on the US dollar?
Yeah, so a couple of things stand out on this chart. One, that it just keeps going, right? and it reminds me that I was told early on that don't fool yourself by thinking that the top of the chart is resistance. Right? I love
Right.
that quote, and it just sticks with me because all the way along here, you're making new highs and you're at the top of the chart, but that is not resistance. So we're seeing higher highs on the dollar.
Yeah.
The other thing that I want to say is that we love, you and I, having worked with GoNoGo charts now for so long, we love clustering of trend continuation icons. So when, like you did here, you see multiple continuation icons as the oscillator finds support at the zero line, multiple tests often leads to a nice move. And we were looking at this a couple of weeks ago, oscillator falling to zero. Surely this time the trend is over, but then multiple trend continuation icons as it found support at zero. And then, of course, now we've popped to a new high again on the dollar.
Absolutely. Now, I know we're looking at the UUP ETF of the dollar index, but if we pop this out to a weekly basis, I'm not sure how far back the data goes, but we're looking at the next area of resistance back at the 2001, 2002 highs. There's still plenty of black space on the chart to get back to those former highs, which I think is encouraging for dollar bulls, certainly in the currency markets, but also this is being driven by investor allocation. And we're seeing a lot of cash being held amongst institutional portfolio managers, often 70% of their portfolios still hiding out in cash because of the damages being done to the equity markets. So important to keep a long-term perspective on this dollar chart as well, as there's still room to run to the upside.
Yeah.
Alex, let's turn our eye over to the oil markets. Much less of a go trend in the crude oil space. But if we just pull up a chart of the USO, what are you seeing from a trend perspective here? And what would you be looking for as a signal for any of this to change?
Yeah, well, I mean, we if anybody's been watching our show, we know how the trend was in oil up to the upside for the year, much of the year up until the summer. We are now seeing a no-go in place. We've moved sideways predominantly, but we made new lows. We rallied, but lower highs. And now the interesting point here is that we seem to be finding resistance at the zero line. So if you imagine flipping the scenario of what we were just talking about with the dollar, we're now in a no-go trend, and we're looking to the zero line to act as resistance. And it seems to be doing that at the moment. So as long as the oscillator stays below or at zero, no-go trend in place, then that's the way it looks. It looks like we may well try to again test these lows from a few weeks ago.
Absolutely. Clustering of trend continuation icons, obviously trend continuation to the downside here for the USO chart. Alex, let's move to some of the names that you cycled through in Monday morning's research note going out to subscribers. Let's start with GASO, GASO, gasoline index. Just to see what we're seeing, what is happening for consumers at the pump.
Yeah, and so we've got obviously it's been a rough week, and there's headwinds for equities in general. But for people as consumers, then this is some relief. We had very high gas prices nationwide, and they have been falling. So this is a gasoline futures contract, and you can see how the no-go trend is a nice, consistent move to the downside, making lower lows and lower highs. And you can see how throughout this period, the concept of the oscillator staying below or at and finding resistance at the zero line has proved to be the case. You can even see a max squeeze here as the oscillators rode the zero line for an extended period of time before falling back into negative territory, giving us that trend continuation icon, suggesting more moves to the downside. Well, we're seeing that again now. The oscillator rising to test the zero line and staying at the zero line. So you love to talk about this situation as that sort of tug of war between the buyers and the sellers, but we're starting to see another squeeze build up here on the gas contract.
Absolutely. Those volatility squeezes are important to identifying topping and basing patterns, but certainly we want to trade in the direction of the break. So that last max squeeze breaking to the downside on heavy volume, continued downward pressure on gasoline. Let's again. This is not a show where we get engaged in the narrative or the storytelling or the politics around where allocations are headed or what's changing in the economy. Instead, we want to just look at the charts and understand what's happening from a price perspective. So please pull up a chart of First Solar, FSLR. And this individual name, we're going to look at the ETF here in just a second, representing sort of that renewables space. But what are you seeing from a trend perspective here on a daily chart of First Solar?
Yeah, well, we've seen this trend in alternative energy or renewable energy sort of mirror, but in an inverse sort of reflection, I suppose, of the movement in oil and gas. So as they've rolled over into no-go trends, we've seen strength in some of these alternative energies, and that's certainly the case with a company like First Solar that we flagged a go trend back in July, and we've really seen a strong move since. This one came into the research note going out this week because it's an interesting moment where we see a little bit of sideways movement and we see the oscillator cooling off and falling to the zero line. So this is where we talk and we look for, when you're in a strong trend, you're looking for those buy the dip moments, those opportunities to take part. So this chart right now isn't screaming, get involved because we might go higher, but we would be watching to see if this finds support at the zero line. And if it rallies back into positive territory, then we would see a trend continuation icon, that green circle, suggesting that momentum is resurging back in the direction of the trend. So maybe we'll move to higher highs. But a strong looking chart at the moment for First Solar.
Absolutely, Alex. And if we can, let's look at a relative ratio of TAN to UGA. Relative strength, obviously, we did a special earlier this summer on how to beat the benchmark, focusing on the concept of relative ratios, using GoNoGo trend on those relative ratios. And so that absolute performance is very important. We want to capture things that are in absolute trends, but also understanding the comparative nature, using technical analysis to allocate to those things that are outperforming on a relative basis. So talk to us about what you're seeing in the trend of these renewables to a gasoline index.
Yeah, well, actually, it's been a very interesting week because this was what we were looking at during the research note went out on Monday, how this outperformance of renewable energy versus gasoline and oil and how strong that trend has been, the series of higher highs and higher lows. Well, we've seen a bit of destruction in that trend over the last couple of bars, and you can actually see the oscillator breaking out of a squeeze to the downside. So this is where we were looking at, should there be support here if the trend is strong, and we haven't seen that. So on a ETF to ETF basis, looking at the overall renewables versus gasoline, this ratio has shown some struggles this week.
Absolutely, potential for a mean reversion trade there.
Yeah,
Alex, counter to how we usually run this show, it would be great to finish up today with our sector ETF GoNoGo RelMap. So, staking with this relative strength narrative, let's look at the sector performance within the S&P while we are in this sharp downtrend in a NoGo and the heaviness of yesterday. So walk us through all of the sectors of the S&P 500 and where we're seeing the relative outperformance.
Yeah, for sure. And it hasn't changed a great deal this week. The performance in the equity markets, we know, is in a strong no-go, and that has only worsened really this week, especially yesterday. And we still see that it's the same culprits. We're seeing technology and we're seeing communications in relative no-go trends to the S&P. Now, they are joined over the last week to 10 days by industrials and materials. So there's a mix of sectors pulling the market lower. But interestingly, it is still mostly defensive sectors that are therefore outperforming on a relative basis. If you look down here, you've got healthcare, you've got staples, you've got utilities in strong go trends relative to the S&P. The one that's still, we always say we don't predict, and we just try to react responsibly, and we certainly don't try to tell people the whys behind what's happening. The discretionary sector is still surprising us, Tyler.
Absolutely. Talking with a systematic quant fund manager late last week about these big targets at the index level from some of the sell side analysts, and projecting 30 or 40% lower. Obviously, not trying to be sensational like Jeremy Grantham was. Everything's in a bubble. It's an everywhere bubble. But realistically, from at the index level, it would not take significant damage to some of these mega cap names to bring the index a lot lower. It wouldn't have to be broad-based sell-off on all of the constituents, but rather just those top holders. So lots to be seen here. We'll be checking back with you every single week here at the GoNoGo show on StockCharts TV. Make sure you tune in every Thursday afternoon at 3:30 p.m. If you're watching on YouTube, that's great. Like and subscribe to the StockCharts TV channel. You can also check out GoNoGo charts on YouTube, and we look forward to seeing you again very soon.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.